Welcome to this essential breakdown on how you can unlock opportunities to create generational wealth right now. In this video, we'll examine a crucial concept that's often misunderstood by investors, but is key to building lasting financial success. By listening closely, you'll see how factors like interest rates influence asset values and how understanding these trends can change your approach to investing forever. As Warren Buffett says, interest rates are to the value of assets what gravity is to matter.
Basically are to the value of assets what gravity is to matter. If I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping.
In recent years, has been when interest rates were sky high, and it looked like a very safe thing to do to put your money into treasury bills with actually the prime rate got up to 21.5%, but you could put out money at huge rates in the early 80s. As attractive as that appeared, it was exactly the wrong thing to be doing. It was better to be buying equities at that time because when interest rates changed, their values changed even much more.
Imagine if you could reduce the pull of gravity by 80%. Suddenly, you'd be able to leap into the air like an Olympic athlete. The same logic applies to interest rates and asset prices. When interest rates drop, the value of stocks, bonds, and real estate rise. This dynamic, often overlooked by novice investors, creates powerful opportunities for wealth accumulation. Let's look back at history to see how this plays out in practice. The best time to buy stocks, according to Buffett, has often been when interest rates were sky high. One such period was in the early 1980s when U.S. interest rates climbed to staggering levels, with the prime rate reaching 21.5%. At that time, investing in treasury bills seemed like the safest move, but in hindsight, it turned out to be exactly the wrong choice. Investors who took advantage of low-priced equities during this period, while interest rates were high, saw enormous gains as rates eventually came down and asset prices soared. Buffett's wisdom teaches us that when interest rates start to drop, asset values like stocks and real estate rise even more dramatically. This principle is tied directly to how government bonds, specifically U.S. Treasury bonds, work. The U.S. economy is the largest in the world, and the U.S. dollar serves as the global reserve currency. U.S. Treasury bonds are considered the gold standard for safety, with their returns often referred to as the risk-free rate. The only way investors could lose on U.S. Treasuries is if the U.S. government defaulted on its debt, which is highly unlikely. This risk-free rate sets a benchmark for all other investments. When Treasury bonds offer a low return, let's say 2%, investors are more inclined to take risks elsewhere, seeking better returns in stocks or real estate. But when Treasury bonds offer higher yields, like the 12% we saw during certain periods in the past, those safer bonds become much more attractive, pulling investors away from riskier assets. Let's take a deeper look into the mechanics behind this. Imagine you're thinking of investing in a rental property. If 10-year U.S. Treasuries are yielding 18% like they did in 1981, you'd only consider buying that rental property if you believed it would generate a return greater than 18% annually. Otherwise, sticking with a safe Treasury bond would make more sense. This same logic applies to stocks. If a company is only expected to generate modest returns and doesn't offer significant growth potential, many investors will opt for the safer, higher-yielding bonds. Here's Warren Buffett himself explaining this concept in simple terms.
In 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
In 1982 or 1983, when long-term government bonds offered 15%, any company earning 15% on equity was worth no more than its book value under those circumstances. You could buy a 30-year strip of bonds and guarantee yourself 15% per year. In that environment, businesses earning 12% were considered subpar. But fast forward to today, where government bonds yield around 3%, and those same businesses earning 12% are suddenly very attractive investments. This is why asset prices fluctuate based on interest rates. When bond yields fall, stocks and real estate become more valuable. So, what does this all mean for today's market? Let's turn back the clock to the start of the pandemic in 2020. As the global economy ground to a halt, the Federal Reserve took swift action, slashing interest rates to nearly zero. This made bond yields almost non-existent, pushing investors toward riskier assets like stocks. As a result, we saw a massive rally in equity markets throughout 2020 and 2021. However, as inflation began to rise, the Federal Reserve changed course. Over the past year, they've been raising interest rates aggressively, bringing the federal funds rate up to around 5.25%. This has also pushed up bond yields, particularly two-year Treasury bonds, which now yield between 4% and 5%. With these higher yields, safer investments like Treasury bonds are becoming more attractive again. This brings us back to the fundamental question of how interest rates affect investment decisions. As the returns on safer investments rise, riskier assets like stocks and real estate must offer even better returns to justify their higher risk. This dynamic makes it crucial for investors to carefully consider the balance between risk and reward in their portfolios, especially in today's high interest rate environment. Understanding this concept is vital as we move forward. The key is recognizing the signs of when a high interest rate cycle is about to end and when central banks like the Federal Reserve are preparing to shift back to quantitative easing. As we enter this period, savvy investors can position themselves for enormous gains by shifting back into equities, just as Warren Buffett advises. Let's listen to Buffett again.
Been when interest rates were sky high, and it looked like a very safe thing to do to put your money into Treasury bills with actually the prime rate got up to 21.5%, but you could put out money at huge rates in the early 80s. As attractive as that appeared, it was exactly the wrong thing to be doing. It was better to be buying equities at that time because when interest rates changed, their values changed even much more. If the dollar was going to do, or interest rates were going to do, we won't do it, but we would engage in transactions involving those commodities in effect, or futures directly. We always try to focus on what's knowable and what's important. What's knowable and important about Coca-Cola is the fact that more and more people are going to consume soft drinks around the world and have been doing so year after year after year, and that Coca-Cola is going to gain share, and that the product is extraordinarily inexpensive relative to the pleasure it brings to people. So that's the kind of thing we focus on. And interest rates and foreign exchange rates, important as they may be in the short term, really are not going to determine whether we get rich over time.
The best time to buy stocks in recent years has been when interest rates were sky high, and it seemed like a safe thing to put your money into Treasury bills. But as attractive as that appeared, it was the wrong thing to do. Buying equities during that time offered much greater returns once interest rates began to fall. This statement highlights one of the most critical lessons in investing: understanding when to rotate into different asset classes based on macroeconomic conditions. Warren Buffett has built his fortune by following three key principles when selecting companies to invest in during times of fluctuating interest rates. First, understanding the business you're investing in. This is what Buffett calls his circle of competence. He avoids investing in complex industries or companies outside his expertise, focusing instead on simple, well-run businesses he fully understands. For example, Buffett's investment in See's Candies illustrates this perfectly. See's Candies has a straightforward product line, a loyal customer base, and a predictable business model. It's easy to understand and generates consistent cash flow, a key factor in Buffett's decision-making process. Second, Buffett looks for companies with a strong and durable competitive advantage, or moat. This moat can take many forms, from brand strength to cost advantages or high switching costs. Coca-Cola is an iconic example of a company with an impenetrable moat. Its powerful global brand and extensive distribution network allow it to maintain pricing power, even during economic downturns. This competitive edge ensures long-term profitability. Third, Buffett places immense value on the quality of a company's management team. A strong leadership team that can make sound decisions and allocate capital wisely is crucial to driving long-term value. For example, Buffett's decision to invest in BNSF Railway was based not only on the company's potential, but also on his confidence in its management to execute efficiently. So, how can you apply these lessons today? As we approach a potential end to the current high interest rate cycle, now may be the perfect time to begin positioning yourself in high-quality, competitively advantaged companies. The Federal Reserve will eventually shift back to easing monetary policy, which will drive down interest rates and push asset values higher once again. Savvy investors who understand this dynamic will have a rare opportunity to accumulate significant wealth during this transition. In conclusion, building generational wealth requires an understanding of macroeconomic forces, especially interest rates, and how they impact asset prices. By learning from Warren Buffett's timeless investment strategies and recognizing when to act based on the market environment, you can position yourself to thrive in the coming years. Remember, the best time to invest in assets is often when it seems counterintuitive. When interest rates are high and markets seem uncertain, that's when the greatest opportunities arise. Thanks for watching. If you found value in today's video, be sure to hit the like button and subscribe so you don't miss out on future content. Drop a comment below with your thoughts or any questions, and I'll make sure to respond. And hey, if you know someone who would benefit from this, share it with them. Don't forget to turn on the notification bell so you're the first to know when new videos go live. Until next time, keep pushing forward and take charge of your success. I'll see you in the next one.